Welcome to this webinar. This is the second webinar we are doing in partnership and collaboration with Asian Development Bank. The last week we spoke about investor relations and why corporate communication and giving greater disclosure is better for bringing efficiency to the stock market, but also why it's important for creating shareholder value. And this week we are going to talk about the debt market and how Pakistan can improve its access to the global markets and how global foreign fund managers look at Pakistan from a debt side. My name is Farid Khwaja. I'm the chairman of KASB Securities. I'm based in London. Over the last 17 years, I have invested in and advised companies and investors of investing in global markets from the US to Hong Kong. As a hedge fund manager, I've invested in equities, primarily in emerging markets, starting from Russia, going down to Eastern Europe, Middle East, and Africa. KSB has been the oldest capital markets business in Pakistan, established in 1952, and has brought in more than $10 billion of global investment to Pakistan. I'm joined by Sana Masood from Asian Development Bank. And before I go to Omar, I'll hop over to Sana to say a few words about ADB and for this webinar. Over to you, Sana.
Thank you, Ali. I'm Sana Masood. I'm the financial sector focal for the Pakistan Office of Asian Development Bank. Thank you, everyone, for joining. Today, we are very happy to be partnering with KSB on this initiative to increase the outreach of what we're doing in terms of knowledge products and investor education. Like Ali mentioned, this is debt markets and bond market development is a topic which is close to our hearts. Many of us, we have an ongoing program with the government of Pakistan for capital market development, which is also focusing a lot on debt markets, government securities, auction processes for domestic markets. And we'd love to hear from Omar today on how the global fund managers perceive Pakistan's debt markets and what are the avenues that we can tap, or what is and access this better. So over to you, Ali, and thank you, Omar, for joining.
Thank you, Sana. So, Omar, really delighted to have you, and thank you for taking time for this webinar. And then just briefly on Omar's background, he has been an emerging markets fund manager, investing in EM debt at Autonomy Capital, before that at More Capital. In both of these places, he has been the youngest fund manager, managing in his last place, managing an investment book of $250 million. Before that, he was a trader at Nomura, and before that at Lehman Brothers. He's a graduate from London School of Economics. Omar, delighted to have you on board for this webinar. Thank you for taking time.
Thank you, Ali. Thank you, Sana. Thank you to KASB, and thank you to ADB, and for the lovely introduction.
That's great, Omar. All the topics, this topic of debt is really important for Pakistan, also for our economic requirements, but also, there has been a lot of debate on hot money and whether it's good or bad. So this is a very heated topic in Pakistan, and debt generally is a subject very important and critical for Pakistan. So I look forward to hearing your presentation and getting your views. You have access to, you can share your screen and share the presentation. So over to you for the presentation, and then we'll do Q&A after that.
Okay, excellent. Let's get into it. Ali, can you see my screen?
Yes, we can.
Okay, perfect. Just move this a little bit. Okay, perfect. So thank you very much to everyone who's listening. This is a great opportunity to speak more about Pakistan, its ability to tap global debt markets, the opportunities, the advantages, and the disadvantages. All right, so I'm going to speak for 15 to 20 minutes. Ali has given my background, and then we will have a short Q&A session, so it'd be good to hear people's remarks, people's questions. I'm going to look to discuss four main topics. Number one, global bond markets. Why do they matter? What's the point of this discussion? Right? I think it's important to set that context, to set that backdrop. And number two, investing in Pakistan through the lens of a foreign investor. I've invested in Pakistan in the MIB market and in the MTB market. My fund invested upwards of $400 million over the past year into the MTB market. So I have significant experience in that area. I have invested in emerging markets from Brazil to China over the last 10 to 12 years. So I have significant experience of investing in Pakistan and also across a range of emerging markets. Number 3, debt strategy. What is the room of improvement? What can be done better with regards to hot money flows? What do other emerging markets do? What do Pakistan's peers do that we can learn from? And number 4 would be concluding remarks. So let's jump into it. Global bond markets, why do they matter? Are global bond markets important? And unequivocally, the answer is yes. I think one of my favorite quotes about global bond markets is from a political advisor to President Bill Clinton, James Carville, who said that if I came back in the next life, I don't want to be the Pope, I don't want to be the president, I want to be the bond market because I can scare everyone. Right, so global bond markets are hugely important. Every successful economy in the world taps global bond markets, whether it's China, whether it's the US, whether it's Japan, whether it's Germany, you name it, and they're all having access to global bond markets. And that's not just a coincidence, it's part of a strategy. Global bond markets are hugely important for economies that have twin deficits, i.e. current account deficits and fiscal deficits. That is the situation that Pakistan often, almost always finds itself in. Pakistan has a fiscal deficit, and the only person financing that fiscal deficit are banks, local banks. Pakistan has a current account deficit, and the only person financing that sadly is the IMF. Right, so how can global bond markets help with this? Let me quickly show you a couple of stylized charts about how global investors can help with this, how global bond markets can help. When there is a fiscal deficit, when the fiscal deficit increases, that leads to increased bond issuance. We're looking at this stylized diagram on the left. When there is more bond issuance, the bond yields go higher. When bond yields go higher, interest payments go higher. And when interest payments go higher, the fiscal deficit, which is the primary deficit plus interest payments, go up. And that's a huge, huge issue. Let's look at the stylized chart on the right. When the fiscal deficit goes up, as is often the case in Pakistan, the current account deficit goes up. There is FX depreciation. The SPP hikes rates. After rate hikes, interest payments go up. And there is a vicious spiral that causes fiscal deficit to go up again. Right, we've seen this movie many times before in Pakistan, and it's not really a movie, it's more of a horror show. However, global bond markets can play a big part in helping to ameliorate this and helping to resolve and reduce this issue. How does it work? Right, if you have global bond investors at this stage over here, when the fiscal deficit goes up and there's more bond issuance, global bond investors can absorb some of the supply of bonds. That means that bond yields will go up by less. That means that interest payments will go up by less, which means the fiscal deficit will increase by less. Right, so that's how global bond markets can help the fiscal deficit. Global bond markets can also help both the fiscal and current account deficit because when the currency depreciates, when the SPP hikes rates, global bond investors can come in and buy Pakistan bonds, right? Which means that yields will rise by less, which means that less FX depreciation is required, which means that less SPP rate hikes are required, right? And I think we can all agree that that's a huge positive. So this is what global bond markets can do. And as a definition, when we speak about global bond markets, I'm talking about the non-resident demand for Pakistan's local currency and hard currency bonds, but it's the non-resident demand. Are global bond markets a panacea? Can they do everything? No, right? Global bond markets can't do everything. They can't resolve the structural, economic, and fiscal problems in a country. Pakistan has gross public debt to GDP standing at 80.8%, according to the March 20 provisional numbers by the SBP. Global bond markets can't change that, right? Those are structural issues. So it's very important right at the outset to understand what can be done and what can't be done. What is the aim of a bond market? The aim is to allow the government to consistently finance itself at the lowest possible long-run borrowing cost. The key point over here is that it's consistency and it's long run. It's not just about finding the cheapest rate to borrow at today. It's about building a market that will provide consistently low financing. And the reason why that's important is because if you look at an economy like Pakistan, the fiscal deficit for full year 19 was something like 8.8% of GDP. Right? Of that 8.8%, the primary fiscal deficit, which is what we call expenditures minus revenues, was something like 3.5% of GDP. So what was the remaining 5.3%? The remaining 5.3% was interest payments. Right? In an economy where you're spending something like 20% of GDP on expenditures for roads, for services for poor people, for building infrastructure, it's not very good that you're spending a quarter of that money on interest payments. Right? If you can have a well-functioning bond market with global interest, you can reduce that long-run cost of borrowing, you can reduce those interest payments, and that money can be used for a lot of good things in Pakistan. So this is why this topic is extremely, extremely important. All right, so let's move nicely on to investing in Pakistan from the lens of the lens of a foreign investor experience. Let's start with the positives, because there were definitely positives when I invested in Pakistan. I was working for a US-based hedge fund. There was a lot of skepticism because they hadn't invested in Pakistan before, but there were a number of positives. Pakistan has a lot of debt to GDP, which also means it also has a lot of debt, which means that there is a liquid market in MTBs, which are the treasury bills. Pakistan has a well-functioning auction schedule, which has started to release. So it's transparent, it's easy to access, it's very readily available for all investors. Pakistan's auction statistics were one of the best that I've seen across the world. Right? Of all the emerging markets that I've invested in, those auction statistics were extremely detailed. So those are positives that we can take away and that we can build upon. But this year, there have been a lot of negatives as well. Right? One big negative has been that there is no game plan from policymakers when it comes to Pakistan's debt market. And I've seen the medium-term debt strategy, and it reads very well. We talk about weighted average costs, weighted average maturity of bonds. We talk about foreign currency exposure. But here is an example. This year, Pakistan could have issued euro bonds at about 400 basis point lower in yields. Right? The amount outstanding in Pakistan's euro bonds is something like $5 billion. So if you do the maths, it's very clear there could have been a saving of something like $200 million if there had been a more timely issuance of euro bonds. That didn't happen. So there has to be some understanding, some accountability, something learned from that experience. It's a huge cost. And ultimately, that's a cost that's borne by society. What else is a negative? The other negative is that, Ali, it's what you mentioned with regards to hot money inflows, right? When the music is playing, people are happy to invest in Pakistan. When the music stops playing, all the investors leave. Right? That's a huge issue. Another issue was the lack of liquidity in the PIB market, that is in the government bond market, in 2-year tenors, in 5-year tenors, in 10-year tenors. It's an underdeveloped market at the moment. Now let's get on to what I think is one of the most important points in our discussion today, which is, what do successful EM bond markets have in common? Right? When the music stops playing, investors are still in Brazil. When the music stops playing, investors are still in Turkey. When the music stops playing, investors are still in South Africa. Same with Malaysia, same with Indonesia. In my experience of investing in all of these markets, I think there are two important dynamics. The first of those important dynamics is that all of these markets are in bond indices. right? And I can't stress this enough, and this is something that we're going to come back and discuss later on as well. Investors are not just there because they want to make a quick buck. They're there because they passively track these markets. Even when the music stops playing, if you are part of a bond market index, the investors will stay. That is the biggest difference between Indonesia and Pakistan. That is the biggest difference between a South Africa and Pakistan. It's not that South Africa is a wonderful economy and people are investing in it because of expectations of huge progress. Most people are investing in it because they have to invest in it because South Africa is part of a bond index. The same with Malaysia, the same with Indonesia. And that's a really important takeaway, and we'll come back to discuss that again. The other important point is that all of these bond markets have a local diversified investor base. Whereas in Pakistan, predominantly the bond market is supported by local banks. We don't have a pension fund industry that supports local bonds. We don't have an insurance fund industry, an asset management industry. So what this means is that in longer dated bonds, there isn't sufficient liquidity. And when you're a foreign investor, you are a lot more hesitant to be investing in long dated bonds. And when you are looking to gain index inclusion, that is also tricky. So when we talk about hot money inflows, what is the simplest way to resolve the issue of hot money inflows? What you want is, as I discussed in the previous chapter, previous slide, you want global bond inflows. What you don't want is hot money inflows. You don't want people to leave when the music stops. The best way to do that is with bond index inclusion and with a strong, diversified local investor base. Even China has these two important dynamics, right? When we look at what China did over the past 2-3 years, China didn't open up its bond market haphazardly. China followed exactly what I have described. China first tried to gain bond market inclusion, and that's one of the biggest things that it did in 2019. And if you look at somewhere like China, the bond market inclusion means it will get something like 10 billion of inflows, which is a drop in the ocean of China's economy, and it's a drop in the ocean of China's bond market. But the whole point over here is that when you have passive inflows, that is a gateway for investors to start investing in other assets in the country. Right? Once they get experience, once they come into the shallow end and they start investing in bonds, they'll say, okay, fine, we might invest in corporate credit. We might invest in equities. It shows to investors, like it showed to my fund, that Pakistan is an opportunity. It is a safe place to be investing. And that's so important. And that's what a bond market inclusion can do. Debt strategy, room for improvement. Again, I think the biggest room for improvement, and this is the single biggest takeaway that that I would like for everyone to leave with, is bond index inclusion. This is the lowest hanging fruit. I think Pakistan can do it. It's very achievable. And what it would mean is it would solve this discourse, Ali, around hot money inflows. It would mean that the capital that comes into Pakistan, at least a large proportion of it, will be sticky, and it will remain when the music stops. It will remain when Pakistan most needs the money. So why bond index inclusion? Well, bond index inclusion in an index such as JP Morgan's GBI EM could mean that Pakistan could get upwards of 10 billion of inflows. I've been talking for the last 10 minutes about the benefits, so I'm sure all of you by now could tell me how important and what global bond index inclusion can do and what global bond inflows could do. So the why part is pretty straightforward. The important part is how, right? How does Pakistan move forward and get bond index inclusion? Again, I don't think this is a particularly onerous process, right? The country level criteria has already been met. The biggest issue is bond level criteria that has not been met. The bond level issues are twofold. One, despite having a large debt market, Pakistan's debt market is not consolidated. If you look at PIB issuance, there is no bond outstanding really that has a size greater than 1 billion. That's the threshold that's needed for index inclusion. There is also a lack of liquidity, as we've discussed, from local participants. And again, if you gain, or as a condition to gain index inclusion, you need that local support so that international investors are able to get in and get out with ease of trading, ease of liquidity. The last option on how to gain index inclusion is to issue a PKR Eurobond as an option. And this is, I think, some of the kind of our intelligent kind of participants and colleagues at the ADB have done more recently. I believe on the 22nd of July, which is yesterday, there was a notice saying that ADB are going to issue international bonds that are linked to PKR, and that in the Eurobond market essentially. And this is what the government of Pakistan also needs to do, right? If you issue a PKR Eurobond that is of a 1 billion size, that can very easily gain access into a bond index. And once that is done, that provides a segue, that provides a path for international investors to start to become comfortable with investing in Pakistan and to solve this dilemma of hot money inflows and to get passive participants to stay in the market. Right, so that PKR Eurobonds are a short-term option. But ultimately what you want is you want to develop the PIB market. Right, rather than having 3 markets, you have to develop the PIB market. The PKR Eurobonds, maybe you can have 1 or 2 to get the ball rolling so that international investors start to look more and more at Pakistan bonds, which is what we need. Now, we've discussed a lot of the important points. I believe people should have a good overview of why global bond markets are important. There should be a good overview of the positives and negatives from a foreign investor perspective about Pakistan's bond market. Very importantly, there should be a good overview of how Pakistan compares to its peers and what it's doing differently and what are other people doing differently and how are they able to attract capital, right? I think there's a little secret over here, and the little secret is this, that foreign investors are not that sophisticated, right? When you look at the BlackRocks, when you look at the PIMCOs, when you look at the Wellingtons that manage trillions and trillions of dollars, a lot of that money tracks passive indices. So the simplest thing, the biggest game changer is to get inclusion into those indices, specifically for Pakistan to gain inclusion into a local bond market index. And I think that should really be the biggest takeaway from our discussion. This is what our peers are doing differently. Even when we look at places like in Egypt, even if we look at somewhere like India, which is next door, all of these places, if they're not in an index, they're trying to get inclusion into the index because it kills 2 birds with 1 stone. It finances your fiscal deficit. It finances your current account. It means that interest rates don't need to be hiked so much, which is damaging for the economy. It means that not as much currency depreciation is required, which is damaging for the economy. I think at this point, what we also need is a game plan, right? When I look at what happened this year was we opened the door for international investors. The music was playing. I think something like $2.5, $3 billion of money came in. Everyone was very happy. But as soon as the music stopped, again, investors left. And for me, that happened because there wasn't a game plan. It was a good opportunity, but we need a game plan. Before we open the international market, we need to create a liquid PIB market so that when investors come in, even if they're speculative, we can say at the same time, look, we have PIBs, we have longer term debt, and investors will start to become attracted into those. That's step 2. Step 3 is the Eurobond option, which is a shortcut to index inclusion. Issue a PKR Eurobond, get index inclusion, get a lot of foreign participants, non-resident investors, investors that have trillions of dollars of AUM looking at Pakistan's bond market. And step 4 is full index inclusion. I think that would really be something that is of huge importance and huge help to Pakistan's bond market and to Pakistan's society. And with that, I'd like to finish and move over to the Q&A stage. I think the DG Desk Office has some remarks. So I'd love to hear any questions, any remarks from him. I'd love to hear some questions from ADB and from Ali and any of you out there. So now,
thank you, Omar. That was very interesting, and thank you for giving those steps for the game plan. If you stop sharing the screen, then I think we can go to the main screen. I think what was very interesting, as you said that foreign investors are not that sophisticated, and I think this is the important realization for insight for people in Pakistan, because I feel that they put very high benchmarks for themselves. When I was on the buy side investing in emerging markets, I remember there was an incident that the chairman of Pakistani SECP came to a roadshow in UK, and he was meeting fund managers. So he came to our offices and he explained how he had, SECP had become more vigilant and has stopped all kinds of financial fraud in Pakistan. And I said to him that, you're the only regulator in the world who has come to us, and we invest in 50 other markets. And we assume that it's not that others are in trying to be really, really clean. And it's not that they don't have those issues. So I think it's important for people in Pakistan to appreciate that when they're, for a foreign fund manager, especially, they have mandates. And if your mandate is to invest in emerging markets, you're not benchmarking Pakistan against the US or UK. You're benchmarking Pakistan against Egypt, which might have a Bangladesh, which might have a lower threshold. And this point on passive investing is also very relevant. I think on the equity side, almost half of the flows which come to Pakistan right now are passive flows. So these guys have, they don't look at the companies. As long as you hit the tick boxes, they will invest in you. And that's why ESG is such an important thing right now, that if you're not compliant on ESG, you might be a really good company and you might have all the best things, but you might not be able to get the investment. So starting from the first question, I think the DG debt office had to go on another call because of a Sukuk issuance, so he sends his regards. But I'm kicking on the first questions from Sana. Can you identify any structural issues that hamper international investors' operational access to the domestic market? And I think I've heard you talk about Euroclear and things like that.
Look, so again, having invested in the likes of Indonesia, India, Egypt, Malaysia, I think Pakistan compares favorably with those. Right, so that's why I started with the positives first. Yes, Pakistan, you require a SACRA account, but the SACRA account is not particularly onerous to set up, right? And its presence there makes sense. Opening of local custodians is not that difficult. So I'm not going to make up stuff and say there are huge issues, because compared to most of Pakistan's peers, the logistics actually are fairly straightforward. It took me 2 months from start to finish to convince my fund and have it logistically running to be able to invest in Pakistan. If I look at somewhere like Indonesia, the previous fund I worked at, it took more than a year. Right? For China, it took more than a year. Right? So that really shows from a foreign investor experience, the logistics is not what's hampering Pakistan investing in Pakistan. The logistics are reasonable. I'm sure we can discuss things over here and there that can be tinkered, that can be improved. But on the whole, I think the logistics of investing through the SACRA mechanism are fairly robust and fairly straightforward. Clearly, Euroclearability would help. But then again, what you want to avoid doing is having a 3-tiered market, right? We already have a market like most countries do. You issue hard currency debt and you issue local currency debt. So that's your domestic bond market and your, let's call it a foreign bond market, right? What you don't want to do is then create another tier, which is a PKR denominated Euro bond market. Right? What should be the ultimate aim is to attract foreign investors into that domestic bond markets. That's what happens in China. That's what happens in Brazil, in South Africa, in all of these economies. The Euro bond market should only be seen as a step in that direction, right? And it's a step in that direction because it helps foreign investors to familiarize themselves with Pakistan bonds, right? There are a lot of investors who haven't looked at Pakistan bonds before. If you issue a Euro bond that is PKR denominated, that is of $1 billion or greater, I can guarantee you all the big investors will be looking at Pakistan because they will have to look at Pakistan.
Thank you for that. You're totally right. I agree with you that Pakistani institutions, in terms of capital market infrastructure, and is actually quite superior to many emerging markets. And a lot of people in Pakistan don't get that. I often get these questions that, why would a foreign fund manager invest in Pakistan? So again, they forget the fact that the mandate is to invest in emerging or frontier markets. So it's a job to invest here. And again, compared to emerging markets, frontier markets, actually, Pakistan is quite good. In terms of your point,
let me pause there, because why does a foreign fund manager invest in Pakistan? Again, it comes back onto the little secret that I said. Foreign fund managers invest in emerging markets not because, for most of them, that they have a revelation in the middle of the night that this is a great investment. It's because they have to invest because the benchmark tells them to. So it's simply a question of the benchmark. Why do foreign bond investors invest in South Africa? Because of the benchmark. So you don't have to reinvent the wheel. You don't have to do something out of the ordinary. Just tick the boxes, get in the bond index, and people invest in Pakistan.
No, thank you. You're spot on that. It's the plan for this, the roadmap for getting inclusions, and a roadmap for accessing investment is often a well-defined roadmap, and it's just about knowing that and following those steps and some of the steps which you laid out. There's a question. You gave the example of China's inclusion into global bond market. The question is, why does that matter? And I don't know whether the question refers to why does that matter for Pakistan, or why does that matter for China?
Sure, let's touch upon both of those. Why does that matter for Pakistan? It doesn't. It's just an example of the fact that Chinese policymakers are intelligent and they plan quite well. And if they think it's a good plan, I think there's something to be taken away from that, purely as a lesson. That's why it matters for Pakistan. Why does it matter for China? Again, I think the point that I made was the nominal sum of money is small for China, right? I think China at the moment has about 10 billion, max it will have about 25 billion dollars of inflows. That sounds like a lot, but Chinese bond market is something like $6 trillion. So it's a drop in the ocean, right? It's really nothing. But still, even though the money is small, it's really interesting, right? Because still the Chinese have gone down that route. And the reason why they've gone down that route is because they know it's easy inflow. It's stable inflow. The Chinese are one of the economies who absolutely don't want hot money inflows. So they've gone down this route. The other reason, as I mentioned previously, is because it's a segue. It's a gateway that allows investors to familiarize themselves with the local bond market. And as you get passive inflows, you get what I call quasi-passive inflows. They're not speculative. They're not hot money that go very quickly, but neither are they benchmark. Right? These are people who can be overweight the benchmark. Right? This is another huge segment of the international investor market. Right? And sometimes these flows can be 50% or 100% of the bond index flows. So those are the reasons why what China is doing in terms of bond market inclusion is important from Pakistan's perspective and also from China's perspective.
Thank you for that. Moving to the next question, do you see any impact of global debt markets for SMEs in Pakistan?
Yeah, I think that there is undoubtedly going to be an impact, right? And again, I think this comes on to the same point, which is that as investors start to familiarize themselves with the bond market, after a year, after 2 years, after 5 years, they start to look at other products in that same space, right? So at first, here is the game plan. First, you get an investor to invest in the MTBs, right? They invest in 3-month bonds, 3-month T-bills, that goes well. Next time they invest in 12-month T-bills, that goes well. Then you get them to invest in PIBs. They invest in a 2-year PIB, a 5-year PIB. And those investments they perform in line with the benchmark, they do okay. As investors familiarize themselves, they become more comfortable with investing in corporate bonds. Right now, I'm not going to say that's a guarantee. Not all countries make that jump, and it comes down to the credit quality and I guess also the currency denomination of the SME bond issuance, whether that is dollar bond, whether that is the local currency, right? But we've seen this in a number of economies where, as international investors familiarize themselves, they start to invest in corporate bonds as well, and that's a huge growing space. As an EM investor, that's a huge growing space. So that's also an opportunity. But the first step to that is the same first step that we've discussed.
That's great. Moving to the next question, and I'm repeating that. If you have questions, please write it down on chat, and then I'll just read it to Omar. So there's a question. I don't understand it, but probably Omar, you will. Could you explain the Cobra effect on markets in light of the fiscal stimulus, which means hot money, debt to equity? It did help to lift global equity markets, but is it sustainable? I suppose the question is the fiscal stimulus, impact of fiscal stimulus on the debt markets. And is it sustainable?
I think it's short term. I think it is sustainable, right? We have to understand why fiscal stimulus is being done. Fiscal stimulus in itself, from a purely Keynesian perspective, helps to boost aggregate demand when there's an aggregate demand deficiency, as we've seen during the COVID shock. So in this case, fiscal spending is picking up the reins when private sector spending is dwindling. So what it does is it averts an even larger economic contraction, which would lead to defaults, which would lead to bankruptcies, which would lead to huge unemployment. So this is why fiscal stimulus and the aggregate demand boost is important, because it helps to circumvent and avoid the worst of the worst shock from COVID. Is it sustainable? And what does this mean for equity markets? I think those are, I guess, more longer reaching questions. I can give you my opinion on those. Is it sustainable? No, I feel that we are entering the whole world is going to enter into a period of lower growth for a number of years. And part of the reason why that will be is because there will be a huge global debt overhang, right? If we look historically at pandemics, if we look historically at wartime economies, not that there is a large sample size, so that can be a caveat. But if you look at what happens, normally the global economy, you have low global rates for 10, 20 years, right? So that's the world that I, as an investor, that's the framework that I have as an investor. What does it mean for equities? I think we have to realize that I'm not an equity investor. I know you can also chime in. I think we have to realize that asset markets are driven as much by fundamentals as they are by liquidity. And this is something that a lot of people realized after 2008, after the huge stimulus. And this is, again, that a lot of intelligent investors are again repeating right now. asset markets are driven by liquidity, which is the amount of money in the system that can be used to buy assets. And that is a tide that lifts all boats. And I think that's what's happening right now. Again, we've seen a huge rally in equity markets, and that's been because of, in my opinion, the significant stimulus, both fiscal and monetary, in the economy, in the global economy.
Absolutely. I think negative interest rates fuel all kinds of asset inflation. Moving to the next question, it's from State Bank of Pakistan, Masood Al-Taj. He thinks Pakistan does have lot sizes of more than $1 billion in certain PIB issues in the 3, 5, and 10-year benchmark tenors. Could you please elaborate a bit more on what else would be needed to get Pakistan access to one of the major bond indices? And the second question is, what other factors might be hindering foreign investors' access to PIBs in particular?
So the first question, in terms of what are the steps? So as I mentioned, the country level criteria has been met. There is a bond level criteria, which is the size of the bond issues and the liquidity in the bond issues. And those are really it. If you have bond issues that are over $1 billion, that's what you need. And number two, you need liquidity. Liquidity is a bit of a thorny issue because it's subjective, right? There is no objective definition of what is a liquid bond market, what is not a liquid bond market. But what helps with liquidity is clearly having a diversified domestic investor base, right? So in terms of having greater liquidity, which is the last remaining step, it would be encouraging local banks to provide more liquidity in longer dated PIBs. It would be encouraging pension funds, encouraging insurance funds, encouraging asset managers to invest in longer dated PIBs. Because without that liquidity, we can't get inclusion into the bond market index. And it's really as simple as that. With regards to the second question, what are the points are hindering global investors from investing in PIBs? That really is the issue, right? When I as a foreign investor invest in the bond market, keeping in mind that I worked at a hedge fund, so it's more short-term as opposed to passive or long-term investing. We actually have to make money. I think passive investors just chug along. Sometimes they make money, sometimes they don't. The biggest thing for me is the yield and the expected currency depreciation. But those things are out of control of the debt management office, right? To a certain extent. If the yield isn't high enough, you can't start issuing bonds at 15%, nor should you, just to attract foreign investors.
Well, thank you for that, Omar. And given the fact that we are talking a lot about the bond index, and JP Morgan has, I think, one of the main ones, and I noticed that Saad Siddiqui is also on the call, our friend from JP Morgan. So Saad, if you can hear me, Taha, can you unmute Saad Siddiqui? And Saad, please, would love to have your comment as well on the steps required on getting into JP Morgan's bond index. Taha, can you please unmute Saad Siddiqui? And in the meanwhile, Saad, can you hear us?
Yeah, can you hear me?
Yes, we can. So we'd love to have your 2 cents on this topic as well, which Omar has highlighted, which I think is really important.
No, well, thank you very much, Ali, for arranging this session. And I've been keenly following all your other previous sessions as well. I think I think people will find them, very beneficial, and they're highly value added. And thanks, Omar, for your insights today as well. Look, I think a lot of ground has already been covered on the importance of the bond index, on why it's such an important anchor, that if you want a bond market really to take off and to become a permanent part of the market background of the policy-making environment, then without an index, it's very difficult to have that permanent level of foreign investor participation and interest, which I think is vital. In terms of the steps, I mean, we now have in the JP Morgan local market index, which is called the GBIEM index. There's close to 20 countries now, so we're somewhere in the high teens, and it's a well-trodden path. I think the first and foremost thing that's necessary is for it to be a priority. So what you find in many emerging markets is that, faced with multiple objectives, faced with periodic, firefights and crises, unless a certain policy aim is really, prioritized as something that a country wants to achieve over, say, a 1 to 2 year horizon, you never really get enough of a momentum or the escape velocity to reach it. So the first thing I would say is it has to be a goal, a stated goal, and it has to be one which has political buy-in domestically, but also there has to be a signal to the world that, hey, we want to get into the index. Because once you do that, what happens is you come onto the radar for foreign investors as well. And a lot of these issues about, what is a liquid bond market, what is not a liquid bond market, that solves itself. We can get out of the chicken and egg issue. But once we tell the world, hey, we want to be in the index, this is kind of a key policy goal for us. You find that the smart investors, those that anticipate future trends, someone like Omar, will already start to get involved in that market before the passive investors get in. And that means the market is already increasing in liquidity even before we start talking about, the formal steps. Now, the formal steps are straightforward. And in terms of, like that Omar had mentioned, the country criteria are met. So Pakistan qualifies as an emerging market. It's got an open capital account. The instrument criteria require a minimum bond size to be $1 billion. Now, there is a caveat here, which is the first bond that goes in has to be $1.5 billion, right? So the first bond is 1.5, and then the subsequent issues are 1 billion. And of course, that has to be not just $1.5 billion size in paper, and it's all kind of held to maturity books in the banks, or it's held locked up elsewhere. There has to be some active trading. And this is where I think it's important for all the policy-making institutions to coordinate with the financial sector and get the local financial sector on board as well to increase turnover and to ensure that that the bond market remains liquid, and not just having turnover in the T-bills, but having turnover in the longer dated securities as well.
Great. Thank you for that, Saad. And I think just to repeat, Saad is the head of emerging market credit research at JP Morgan, and JP Morgan is one of perhaps the largest bond index provider for bonds. So moving back, thank you for that input, Saad. Moving back to Omar. Omar, there's a question that what is your outlook for credit? How do you distinguish between investment grade and high yield? Can there be a general perspective? And I'm combining that with the next question because of time. Can you give us some idea about what are the main followed bond indices, both on the global level and on emerging market level? So what are the key indices which are relevant for bond investors?
Sure. So first question first, on credit definition, high grade, investment grade and high yield. I think that's fairly elementary. It's a question of rating through rating agencies, Moody's, Fitch, and S&P's. It's BBB+. If you're going to BBB territory, below BBB territory, that's when your rating changes. So that is fairly straightforward. In terms of my outlook for credit, it depends credit where, right? But I think generally, again, my outlook is that in this environment of excess liquidity in the global financial markets, that liquidity will find itself up the yield curve, up the credit curve. In first instance, that money finds itself in government bond markets, in DM. After that, you start finding investors putting their money into credit, DM credit, and EM government bonds, both in terms of hard currency and local currency. So I think the outlook for credit, it really depends on which credit markets we're speaking about. But I think for me, it would remain broadly positive. I'd be more convicted, in my view, in investment grade credit in the US and in Europe. I'm not going to start speaking about, let's say, SMEs in all emerging markets. I don't think those will necessarily do well, but I think it will be broadly good for the credit markets. In terms of key indices, as Saad kindly mentioned, as you mentioned, I think the most important one to start off with is the JP Morgan GBI EM index. The other two indices are the WGBI index, which is the World Government Bond Index, which is Citi's index, and the last one is the Barclays Bloomberg Aggregate, which is the third remaining bond index. So those are the three ones, and those particular ones, to be very precise, are more for local currency government bonds. For hard currency government bonds, you have other bond indices such as JP Morgan's EMBI, which is the Emerging Market Bond Index. So in all of our discussion, I think we have to be very, very precise and understand the difference between hard currency debt and local currency debt. So really the focus at the moment is index inclusion for local currency debt. And the three important ones there: number one, JP Morgan, GBI EM; number two, Citi WGBI; number three, Barclays Global Ag.
Thank you for that, Omar. There's a question, and there are a few earlier questions as well, which are Pakistan specific on the capital markets. And Omar invest in the bond market, and I don't know how comfortable you will be on giving an outlook on Pakistani stock market, but I'll still ask you the question on the exchange rate. Do you have any opinion on Pakistani exchange rate and interest rates?
Sure. Exchange rate, I feel it should be, it's going to be tricky, but I think broadly it'll be stable for the foreseeable future. We've come out of a huge shock to the economy in terms of the external account. Inputs have been hit, exports have also declined, but the external account seems in a better position. I think as long as the fiscal situation can be sorted out, and by that I mean, and this is the sad situation, right? I mean, fiscal tightening is short-term harmful for the economy, because this is an economy where there are a lot of people who need support from the government. In the long term, however, fiscal tightening is needed, because what it means is that you don't have this boom and bust cycle. You don't have the same situation in 5 years' time when the currency depreciates 50% and interest rates go to 15%. Right? You don't want that situation. Right? So short-term pain, long-term gain, and that's what fiscal tightening means. So I'm being mildly constructive on Pakistan's exchange rate, and by mildly constructive, basically what it means is that dollar PKR should remain in this range if it's managed to survive thus far. Long term, it comes down to the fiscal situation. Pakistan has a very precarious debt situation. Debt to GDP is 80.8%, according to the latest SBB numbers, the provisional numbers of the March 2020 report. The difference between nominal interest rates and nominal growth is quite wide. So debt sustainability is not on a good path. And therefore, if we can't sort out the fiscal, the currency will undoubtedly depreciate again.
Thank you for that.
What else? You asked about
interest rates.
Interest rates, I believe, will come lower, right? They'll remain low, they'll come lower. The reason why they'll come lower is because economic growth has been, unfortunately, due to COVID and due to the previous economic kind of already the troubles. Economic growth has taken a significant hit. Domestic absorption will decline. Core inflationary pressures in the economy will subside. Transitory inflation that comes from FX depreciation with a lag will also start to subside. So inflation inevitably will start to drift lower, and the economy needs and warrants lower interest rates. So the interest rates will slowly come down. The big question is at what level they will settle. And that will depend both on the requirements for the domestic economy and the requirements to keep PKR stable.
Thank you. The next question is from our friend, Dr. Salman Ahmed. Dr. Salman Ahmed was the CIO of Lombard ODA, and now he's on his way to become the global head of macro at Fidelity, one of the largest asset managers in the world. He appreciates the presentation, Omar, and he's asking that, does managed FX regime make Pakistan more or less attractive, given that managed FX regime is unsustainable? So thank you for that question, Salman.
Thank you, Salman. I think that's an extremely important question. I think we have to really look at the periods when currency is managed. All emerging markets, let's not say all, but many emerging markets manage their currencies, especially during periods such as what's happened over the past 4 months. Indonesia was managing its bond market, its FX market, and its NDF market, right? Brazil was managing its market. Mexico was managing its market in terms of the FX. So Pakistan is not the only place that's managing its FX market. You're right. Long-term FX management is unsustainable and it's not recommended, because what you do is you create long-term pressure, and it creates a pressure to have large one-off devals. Short-term FX management during periods of stress helps to reduce that stress. It helps a orderly exit of capital, which stops a vicious spiral from happening, right? If you allow capital, let's say if $10 billion needs to leave an economy, let's say if you manage that and you only allow a 5% of FX depreciation, okay, that number may stay at 10 billion. If you allow a 20% FX depreciation, that creates a vicious spiral, and instead of being 10 billion, 30 billion ends up leaving the economy. All right, so this is why we really have to be very nuanced. It's not a black and white answer, is FX management good or bad? It's long-term FX management is not good, especially when you don't have the FX reserves to do it. Short-term FX management during periods of stress is sometimes necessary and often have a beneficial impact. And I don't think Pakistan is the only place that's doing it.
I agree. And then when I talk to investors and when I pitch Pakistan to them, their primary concern is about FX. That's the first conversation, at least on the equity side, starts with FX, and probably that takes 80% of the time in terms of addressing the concerns around it. So stability on that, it almost seems like a prerequisite.
I mean, it comes back to again the point that Saad kindly made that you've discussed. Which is, if you're a passive investor, the conversation is not about the FX anymore. Right? If you're an active investor, you're thinking, okay, fine, look, I'm getting 8% yield, and you're always worried, okay, how much of that yield will be eaten up by FX depreciation? If you're a passive investor, that's less of a discussion. But you're right, it's an extremely important discussion. It's an extremely important part of the equation. Nor should we want, and I think this is to Salman's point, and he raises a very good point. We want investors who come into the market who acknowledge risks, and you shouldn't always be backstopping international investors, right? International investors should not have a free lunch, right? You shouldn't underwrite international investments and say, hey, come into the market, make the money that you want. If you make money, great. If you don't make money, we're going to backstop you. That's not right either. So I think Salman's point to that is extremely pertinent. You should have two-way volatility in the FX market. Long term, the FX market should be free floating. Short term, during periods of stress, I feel central banks have a part to play as a circuit breaker.
Absolutely. Your comment on passive investment is quite relevant also from the equity perspective, because there is a big debate that Pakistan is right now a part of MSCI Emerging Markets Index, but should it choose to downgrade itself to the Frontier Market Index? And I don't know the answer to this because I have not done the numbers on the relative size of the markets, but I do think that there have been consistent outflows from the frontier market indices, and there is of course the better option would be to strive to get a higher allocation within the emerging market index rather than to get yourself downgraded to the smaller market, and striving for as you pointed out, striving for a higher share and allocation within a bigger index is often following a rule book, which we can control. So while we won't be able to control other things such as the macro variables and the quality of the earnings, but we can follow the rule book and aim to improve the thing which gets a higher allocation? This is a very interesting question, and perhaps this will be the last question for this because we're running out of time. How do foreign investors see Islamic bonds globally, and what's the level of interest, and how do they see the risks of investing in Islamic bonds?
Sure. Look, I think broadly speaking, there are two kinds of foreign investors. Those that are passive and follow indices, those that are active and want to make money. If there is money to be made in Islamic bonds, people will invest in them. So it comes down to a function of yield. There is no, it really is that much. There is nothing beyond that. I have invested in sukuks, sukuk-like instruments in Malaysia. Indonesia, I believe, has a market. Obviously, in the Middle East, there is a market. And these are markets that are thriving, and there is international interest in them. So there is nothing that stops international investors. There's no kind of ideological predilection that people have that provides a hurdle for them to not invest in sukuk bonds. Clearly, I think it's a subset of the market, and we should try and focus on the points already mentioned. I think that's greatly more important. But sukuk bonds they are part of the market, and international investors are comfortable, and these days most international investors are conversant with them. Alternatively, I'm sure there are passive indices that sukuk bonds can also get onto, and then you get passive money as well. But there is the succinct answer is sukuk bonds. International investors are very happy about. There is no issue.
No, thank you for your time, Omar. I think what was very interesting for me is that how what you said ties in very closely with what we discussed in the last webinar we had with Simon Trisham on investor communication. And his main point was also that when you're talking to an investor, you should be aware of what he can or cannot do, because often investors are just following guidelines. So if you're going, and as you said, like on that question on Islamic bonds, that if the investor is investing in passive, he will follow the mandate. If he's investing in active, he's there to make profits, and he will follow the return and based on that. So having effective communication with the right investor base is extremely important. And I think for me, that's the main takeaway from your presentation, that there are some easy wins for Pakistan, some low-hanging fruits in terms of just following that rule book, making sure that we hit all the tick boxes and get allocations from investors where we can. Thank you for your time. Thank you for all the listeners. The recording of this video will be available on KASB's website. This was being live telecasted on 2 platforms, DBTV as well as Capital Stake. And the recording and the presentation will be available on our website, kasb.com. Thank you, Omar, for your time, and thank you for all the listeners.
Thank you very much, everyone. Thank you for the wonderful questions. Thank you, Ali. Thank you, KASB. Thank you, ADB. It's been a pleasure. And if anybody has any further questions, feel free to reach out. So thank you, and all the best.
Thank you. Khuda Hafiz.
Love it.